Hello, everybody. Welcome to the webinar. We will be starting shortly. We are just waiting for some more participants to arrive. So we've got a good number of people participating. I think we'll kick off. Welcome, everyone, to the July edition of the Kallanish Global Steel Markets webinar. I hope you're all keeping very well. Greetings from sunny Frankfurt. As a first and foremost, I would very much like to thank our sponsor of this webinar, Borusan Mannesmann. We very much appreciate their support and their participation in this event. I am the Kallanish Global Editor. My name is Adam Smith. I will be presenting today, as well as three of my colleagues, who are Tom Gutierrez, our Asia editor, Dan Hilliard, our America editor, and Emanuele Ornorsa, who's our Europe editor. We will be covering topics which are relevant around the world globally, such as the ones you can see here on this slide. These are the titles of our presentations. The format will be the 4 presentations, followed by a question and answer session at the end. You don't have to wait until the end to ask a question. If you have one in your mind as one of our presenters is speaking, then feel free to put it into the question or chat function, which is on your right-hand side on the control panel there, and we will answer everything at the end in the Q&A session. During the presentations, we will be running polls with multiple choice answers. I strongly recommend everybody to partake. We want to make this webinar as interactive as possible, and it will be very interesting to hear your views and integrate them with our presentations. There is the presentations that you will see today. They are available to download again from the control panel on the right-hand side of your screen from the handout section. And the video recording of this webinar will be available within 24 hours on YouTube. So I believe that's the introductions done for now. Without further ado, I would like to hand over to my colleague Emanuele Ornorsa, who will be giving the first presentation about the European steel market. Emanuele, please take it away.
Thank you very much, Adam, and hello. Thank you again for joining us in this webinar, which I think is going to be quite interesting as usual. I will start, as the title of my presentation says, looking mainly at how the European demand and steel prices could recover, especially given the fact that we have been expecting a recovery, in particular in terms of prices, for a month now, and it's not really visible yet in the market. So we're going to understand why and what are what is going to happen in the next weeks. So let's start with the first slide. So these ones you probably saw. I wanted to start by talking with the sorry, it went, yes, excuse me, it's just going too far. Let me start again. Yes, sorry. So I wanted to start by looking at the situation of demand in the 2 biggest sector, industrial sector and construction sector. So according to the Eurostat number in May, you can see the recovery that industrial production did after the slump that we saw in April, during which most of the countries were in lockdown. The recovery has been quite strong, but definitely not enough to be considered positive enough to revitalize demand. We're still waiting for numbers. Of course, the recovery should continue further in June, but then the beginning of the summer slowdown should kick in. So we're in a very difficult situation in which we knew that industrial production was already going down since, of course, last year. So in particular, it was the negative trend in terms of output, and then there was a slump in April, and the May recovery was visible, but not as much as, for example, we saw in the construction sector. So if we look in the construction sector, you can see a clear recovery, taking it, of course, far from the levels that we had before the coronavirus crisis, but showing the recovery is actually gathering pace and could continue in June and in July. Also, if we look at the situation now with different European countries, investment seem to be arriving, or at least be prepared, and they should be able to impact quite strongly, mainly the construction sector. So at this stage is clear to see a better position for the construction sector. Therefore, for example, long products rather than the industrial and automotive sector, which is struggling, as we all knew from already mid last year. If we look into details on prices, you can see here I put HRC in Northern Europe and rebar in Northern Europe. You can see clearly the negative trend that we saw since beginning of March, end of February, so when the coronavirus crisis hit Europe. But again, in here you can see also very clearly how quickly HRC prices went down, for example, in Northern Europe to below 400 euros, whereas Northern European rebar prices fell, but not as much. So they sort of limit their fall. Also, you can see that rebar prices have stabilized during the last 3 weeks. They did a slight recovery, then went down again, but they look to be stabilizing. HRC prices are expected to recover, but the recovery is not happening yet. So clearly, at the moment, flat products are suffering more than long products in Europe, at least. And if we look into more details in this next, you can see the announcements that ArcelorMittal started to do on the 20th of June, and that were then followed by many different suppliers of flat products, including Tata Steel as late as last week for the UK market, for example. So there is a clear indication that flat products supplier need to increase their base level for coils to at least 430 to 440 euros per ton in Northern Europe, but this level is still not there. Our assessment is still around the 400 euros mark, and it's not yet moving up that much. And if we look into the next slide, you can see that clearly all signs are there to show that a recovery for HRC prices is possible. You can see here on the blue line the import offers into Southern Europe that picked up and that are now clearly above non-competitive, let's say, compared to Italian prices, but also Northern European prices. You can see how volatile is the Italian level, which nevertheless showed a clear recovery from the lowest point reached a month ago, more or less. So the differential between Northern Europe and Southern Europe is also and Italy, sorry, it's also relatively low. So clearly there is support on if we analyze the prices for HRC in Northern Europe to move up. But so far the market has not been really active that much, and of course this ties with what we said at the beginning. Whereas the construction sector is showing signs of recovery, on the industrial sector and automotive, of course, the path to recovery seems to be quite a lot longer, and this is impacting prices. I wanted to put here also a slide that you should be able to see that I actually took from Stalmark Consult, which is a consulting agency in Germany. They used in a Eurometal webinar recently, but I think it's quite interesting because they put together all the input costs for the production of HRC via the furnace route, and they calculated that in June the differential, the margin on the sales of HRC went below 200 euros for the first time, at least since January 2017. So on that front, again, we can see that input costs are relatively high. We will hear from Thomas on iron ore, which remains around the $110 in China. So input costs are still high. The margins of the mills are very low on their sales of HRC, but still the price is not moving enough. So definitely the problem seems to be remaining demand. And at this point, I would like to pull up the poll that we have for this week. Yeah, so up to you.
So, ladies and gentlemen, the question is, will Northern European transaction levels reach 450 euros per ton ex-works base by the end of this year? Yes or no? The voting is completely anonymous, so please get stuck in and vote. We want to know your opinions, and we'll give you another 30 seconds. We've got a good percentage of participants voting so far. Will transaction prices reach 450 euros per ton ex-works base by the end of this year? Yes or no? A few more seconds, we'll bring the poll to a close.
So it looks like the answers are split. So we have a 51% and 49%. Yes is winning by only 2%. And that's exactly the reason why I asked this question. If we can get to our to my presentation, please. The reason is that it's very difficult to predict what is going to happen with HRC prices. We're really there at the limit. In my opinion, by the end of the year, we should be to recover the 450 euros for HRC. But of course, this depends on two factors mainly. The first is, of course, the situation of the coronavirus. So we've seen in other parts of the world second waves or let's say problems arising. In Europe, the situation seems to be under control. If it remains under control for the next months, then I believe also on the industrial front, demand could gather a little bit of pace, and therefore prices can recover. But if demand doesn't pick up, it's very difficult, especially because even if we look on another element that should be helping prices, which is the safeguard measures. We all know that the safeguard review was approved and launched since the beginning of July. There are some changes, in particular the fact that each of the quotas will only be used quarterly, so there will be no possibility to use the entire quota from a year in July, for example. So there is a slight limitation, but this has been entered into force in a moment in which imports anyway were reducing because of demand. So the impact of the limitation imposed by the new safeguard rules will not be so visible in the market, in my opinion. And the interesting part is that if you look at the next slide, which shows, for example, which products reach a critical level at the moment, meaning the quotas are almost finished or finished in some cases. There are only a few numbers. The only really relevant ones are probably Turkish rebar, which we all knew it happened last year. All of the quotas for the year were used up in a week. Now it's been, of course, only the quarterly quotas. Russian wire rod, of course. And then if you look further down, Chinese hot dip galvanized in the 4B subgroup, meaning for the automotive sector. So all the others do not seem to be critical, and this is of course because import levels have been slowing down as a in response to slower demand. So even the safeguard and the limitation on imports are not having that big effect. So eventually the only real drive will be demand, and at the moment we can say that the construction demand can be driven by some investments and some decisions on a political level. The industrial and automotive demand seems to be lagging behind in that sense, and we need to see what happens in the next months. So it's all for me, and I will leave it to Adam to present Tom. Thank you.
Thank you very much, Emanuele, for that fascinating insight into the European steel market. The poll result there was almost like Brexit all over again, split right down the middle. Shows how polarized the opinion is on pricing in this very volatile environment. I would like to remind you before we carry on with our next presentation that any questions that you do have, please do enter them into the control panel on the right-hand side. It's anonymous, and we would like to address your questions at the end in the Q&A session. We're looking forward to receiving them. So without further ado, I would like to welcome my colleague Tom Gutierrez, who is our Asia editor. Welcome to the so-called stage, virtual stage, and Tom will be talking a little bit about China and iron ore. So take it away, Tom.
Thanks, Adam. I hope I never have to hear the phrase "looks just like Brexit" all over again. I'm going to talk mainly about what's happening in China, what has happened over the last month, and obviously I think people have noticed what's going on with prices, and is it due to the lack of a slowdown, or is it that China has somehow breezed past the slowdown? So the first thing to look at is, was there a slowdown? Obviously, if you look at prices, you could be forgiven for thinking that there was no slowdown. But in fact, the slowdown was real, it's measurable. This is the real demand in June on a daily basis, and you can see a very clear decline since the peak in April. From that point in July, demand has been further disrupted. As you've probably seen in the news, there's been very heavy rains and flooding. Flooding in particular in southern China, which has been very disruptive, but also just an extended rainy season in eastern China, which has disrupted construction activity. So there has been a genuine decline in demand, even though overall demand has recovered very strongly in Q2 compared to Q1, and also with an increase year on year, so that over the first half of the year, demand is now essentially flat year on year. So if we look at the impact on prices, here you can see hot rolled coil in particular has more or less ignored the fact that there's a slowdown in demand. Rebar has been a little bit more subdued, mainly because the impact on demand has been concentrated in construction activity, and so rebar prices have been particularly hit. Also, of course, our rebar prices are focused in Shanghai, and Shanghai is one of the areas that has had construction activity disrupted by the rainy weather. So there's a few reasons for that, including high iron ore, but the high iron ore and the high steel prices are really due to the same factors. It's mainly due to China, despite some supply issues in iron ore. China has been the dominant story, and it's really an improvement in sentiment that has driven that. So if we look at that improvement in sentiment, just as an example, I'm using the poll question that we actually did last month. If you look here, rebar prices, we asked last month if people expect prices to remain firm, fall 100 kwai, fall 100 to 200 kwai, or fall more than 200 kwai, and only 18% of people expected rebar prices to remain firm. So what changed between a month ago and now is really a change in sentiment, and that's been partly fueled by government policy and also government measures to support stimulus, so and to support sentiment. So that includes the stock market rally, but it also includes very high bond issuance and other factors to support sentiment. So before we go on, I'd like to take a measure to see what you think now. So I'm going to ask Adam to pull up the poll question.
Thank you very much, Tom. So the next poll question is, how do you see Chinese rebar prices by late August? Is it up 200 yen, up 100, flat, down 100, or down 200 RMB? So how do you see Chinese rebar prices by late August? Again, we'll do 60 seconds of voting. Votes coming in thick and fast. It looks like we have a clear, not a clear favorite, but two favorites, I should say. Please vote if you haven't done so already. It's anonymous. We'll be closing the voting in 5 seconds.
Okay, thanks, Adam. It seems like most people expect prices to remain fairly flat through the summer, so not a lot of movement. A slight advantage for people who think prices will increase a little rather than people who think prices will decrease a little. So it suggests that really the sentiment change over the last month is being felt globally among all our attendees, from almost everybody expecting prices to fall a month ago. People now overall expect prices to stay flat or to increase. Thanks, Adam. If we can go back to the slides. Thanks. So let's take a little look at some of the things that are behind that. So if we look at what's supporting prices over the next month or so, one of the things we can look to is inventories. A month ago, it was expected that inventories would increase because production has been very high and demand has slowed down a little bit. That did in fact happen. Inventories did increase, but the increase was fairly modest, and that increase has since slowed down. So one issue is that output has declined a little bit from the very high levels that we'd seen earlier in the year. That has mainly been seen in electric arc furnace production, but there has also been a decline in blast furnace activity. And now that we're in a position where inventories have not increased very significantly, we're now starting to see a pickup in demand. So in fact, particularly from this week and yesterday and today, Eastern China has started to have much better weather. Construction activity is picking up. There's still a bit of a way to go in southern China, which has obviously been much more seriously disrupted by floods. But the outlook for the coming weeks is that demand should pick up, and that inventory increase should be a small blip rather than a more serious problem. And then going forward after the summer, then of course people are looking forward already to the autumn increase in demand. So the Chinese economy has really been primed to have a very intensive period of spending before the end of the year. And a key example of that is the flow of local government special bonds. These bonds are issued by central government to local government, and local government can then issue them to raise funds for particular projects. And if you look at what's happened so far this year, you can see 3 spikes. The first spike, December, January, the economy had actually already been pre-primed before coronavirus. China was planning to spend a lot of money this year in order to hit GDP targets and hit its goal of becoming a moderately wealthy moderately prosperous society by the end of the year. From March, you then saw an accelerated issuance of bonds as an immediate response to the coronavirus crisis. And then from May, you started to see a much bigger spike, which was due to the increased bond allocations that were announced during the 2 sessions in Beijing. And that money is now has been distributed essentially to local governments and is ready to go into projects. And those projects are now mainly listed out and being prepared for actual spending activity and actual construction in the second half of the year. So that's helped to give people a lot of confidence that if they hold material now and steel, it will still be worth more money in the autumn than it is now. And so that's helped helped traders to sustain prices at current levels rather than selling down. There's also a shift in the steel intensity of these projects. If you go back a year ago, a lot of the investments were basically local governments filling financial gaps in their budgets wherever they could. Now there's a much stronger focus on environmental infrastructure, on transport infrastructure, and also on some redevelopment, urban infrastructure redevelopment projects, all of which will be quite steel intensive. And that strong demand obviously has also led to strong imports, and that's key both to the steel market and to the iron ore market. Obviously, iron ore has been very high, very strong, sustained at above $110 a ton this week, and no sign in the immediate future of that declining. But really, the steel import story is perhaps even more surprising considering China's history. China is now moving closer and closer to becoming, at least for a short period, a net importer of steel. So if you look here, this only goes up to the May data, but you already have imports coming back to the level seen last December. And if you look at June, you already have the finished steel data, which has been released, shows an increase of around another 600,000 tons in the month. And you have semis, entering the level of around 1 million tons a month of semis imports as well. So that increase has continued, and we still now, with high Chinese prices, are seeing more deals signed. So that has included from the suppliers which have become key suppliers over the last few months, like India. Indian HRC has been coming in, but also we now have some more surprising suppliers. So this week we heard 100,000 tons of Vietnamese HRC being sold into China. The Chinese HRC export market to Vietnam used to be the largest steel trade flow globally, and now it is reversing, and Vietnam is actually exporting HRC into China. So I'm going to leave it there, but I'm very happy to answer your questions. And if you feel I've missed anything out, then please do raise it, and we will answer everything at the end. Back to you, Adam.
Thank you very much, Thomas. It's good to hear that the Chinese government is implementing measures to stimulate the economy. Everyone is looking at China right now, and it's really propping up the rest of the steel market, which isn't doing as well globally. So our next speaker is my colleague Dan Hilliard, who will be talking to us a little bit about North America. It's always interesting to hear his thoughts on the market as well as on the politics. So I'll leave it to you, Dan.
Thank you, Adam. I am Dan Hilliard, reporting from just outside Pittsburgh, Pennsylvania. And today I want to talk a little bit about the Independence Day slump, summer slowdown, or COVID crush. So at the end of June, things were actually looking up across most product categories. There was a slow build in pricing on hot rolled coil. There was a slow build in pricing in plate. The only products that were really doing poorly were the ones in the oil field, which kind of suffered the twin hammers at the beginning of this year of COVID-19 and the global price war. But overall, things were improving. COVID numbers were going down, reopenings were on pace. That all kind of hit a wall at the Independence Day holiday, July 4th. After a brief period of recovery following the first sort of acute phase of COVID-19, and the exclamation point is for the first acute phase, as we'll talk about shortly, pricing now appears to have stalled across pretty much all categories. Hot rolled coil is now below the psychologically important $500 per short ton barrier. Plate is likewise below the 600 barrier, and increases that were expected for both products have been put on hold. But hold on to that, because we're going to talk about at the end. That actually changed just late last night, this morning. And finally, oil fields, faint glimmer of recovery has mostly evaporated. There was some hope that some supply chains would be opened up, there would be some inventory holes filled, and now that has largely gone by the wayside. So this chart is just illustrative of the very recent trend. There was a slow but very steady build up, followed by a sort of a retrenchment. It remains to be seen whether that line will continue to curve down. I've included the Chinese price as sort of a global baseline to show you that basically things had been improving in steps, definitive steps, not fits and starts, and now they're starting to slowly trend back down. So the big question is why? It's tempting to just say maybe we're in the middle of the traditional summer slowdown. Typically, the US right now would be experiencing mill outages and auto shutdowns, partly because it's fairly miserable to be in a steel mill or an auto plant in the heat of summer, and it's a good opportunity to get any kind of scheduled maintenance done, those kind of things, while the market is in a traditional slow period. However, this year, auto is struggling to recoup lost ground that it suffered as a result of COVID-19. And mills are doing absolutely everything possible to get back to a at least reasonable capacity utilization number. Furthermore, order entry rates, according to mill sources, are fairly good. They're being buoyed or buttressed by contracted demand from the auto, from HVAC, from white goods manufacturers, not so much spot, but large contract heavy businesses. So why is the price sinking? And unfortunately, we're going to have to head to the beach for a possible answer. So at the end of June, COVID numbers were going down pretty much across the US. And I just want to briefly explain a little bit about how the US has structured its recovery. And this is independent of any political opinions I or anyone else might have. This is just the mechanics of it. There was a system set up built on the familiar stoplight, red, yellow, green. Red was the initial acute phase. It was everything stops, only no non-essential travel, only grocery stores open. Basically, don't go outside unless you have to. That's red. Yellow is where we spent most of our time, and that was don't go outside unless you really have to, or you just kind of want to. Many stores were open at reduced capacity, and just a general aura of caution sort of pervaded. Green was supposed to be kind of an enhanced yellow. More businesses could be open. They could open at greater capacity, but generally no more than 50%. And mask wearing was still encouraged, though not mandated by law. Essentially, the move from yellow to green was a much smaller step than the step from red to yellow. However, as soon as green rolled around, which was right before the 4th of July holiday, many people in the US interpreted green as the traditional. Green means go. When you're sitting in a car and the light flips from yellow to green, you stomp on the gas, don't you? And now we're facing new record highs throughout the Sun Belt. The picture you see is actually in Coney Island, New York, which is not in the Sun Belt, so it's even worse further south. And the Sun Belt also encompasses pretty much everything from North Carolina, South Carolina, all the way over to Arizona, which is all of our nice beaches, all of our nice vacation spots, and all of our mini mills, most of our mini mills, and all of our auto transplants. So if there's been a steel mill built since the 1970s, it's likely in the highest swath of COVID-19 right now. So this is throwing huge amounts of uncertainty into the general market, up and down the supply chain. Who's really willing to spend or invest in this climate? Everyone is still trying to retrench and recoup losses from the initial phase of COVID-19, but business as a whole is very uncertain. And that's even taken into account that this year would have been an uncertain investment climate anyway due to the November presidential election. So as I move on to this next slide and we discuss where we go from here, I'm going to go ahead and ask for the poll. I want to hear your opinions on maybe where we go next in terms of capacity. So if we could go ahead and pull that up right now.
Okay, ladies and gents. So the question is, when do you believe capacity utilization will top 75% again? Will it be in Q3, Q4, 2021, or 2022? Don't be shy. Voting is anonymous. And as Dan said, we really want to hear your views. I'll give you 30 more seconds to vote. When will capacity utilization top 75% again? Everyone has an opinion on this one. Voting is coming in very fast. 10 more seconds. And we'll close the poll.
Okay, thank you, Adam. That is extremely interesting. I do concur that Q3 is likely impossible. And just for background, I should have mentioned this before. Capacity utilization is currently hovering right about, I believe, 55 to 58% was the last number. Q4 is likely impossible, even just due to the holiday season. The 2021 figure is realistic, but what really stands out to me here is the 2022. We're likely in a very long, slow recovery. And it initially appeared that things would bounce back relatively quickly. We now know that's probably not the case, at least in the US. We have a lot of structural things to deal with in the next several months. We have a presidential election. We have a populace that is very, very unfriendly to the idea of cooperating to quash COVID, and things are just going to be a little bit hairy until things naturally work out. And I do believe that that'll happen next year, but it is possible that we'll be dealing with at least some COVID complications into 2022. Just some bright spots so I don't completely depress you on a Wednesday morning. COVID is not directly impacting steel mill production as it was previously. There is a general move throughout the industry to bring capacity utilization back, and it is working. It is mainly affecting steel at the consumer level. Folks are not buying the cars and washing machines that they should be, partly because the economy in general is not very good. Our job losses were horrific. Stimulus packages are more rumors at this point than reality, and that introduces a lot of uncertainty, and we'll be dealing with that for some time. There is the possibility that the lack of a true summer slowdown is establishing some kind of pent-up demand, but it'll be a little while before we realize that, at least probably into Q1, before we see any kind of pent-up demand. I just want to leave you with one bright spot I heard this week, which was interesting to me. Mechanical and structural tube is doing great business right now, primarily due to a huge buy-up of home gym equipment as a result of the COVID restrictions and folks being confined to their homes. All the heavy hitters, however, oil, construction, white goods, they're all dormant and waiting for a new opportunity. Earnings season has actually begun in earnest. It'll really kick off next week. And I would just want to leave you with this. It really only can get better from here. Thank you. And I hope you stay safe and sane out there.
Thank you very much for that presentation, Dan, and I'm very glad you ended on that bright note, just what we need in the middle of the week on a Wednesday to push us into the second half of the week. Just before I begin my presentation, I would like to remind everyone again to ask a question in the control panel if you haven't done so already. We've got a lot of questions come in so far, so that's very good. Thank you for your participation, and we will be answering them after my presentation in the Q&A session very shortly. So last but hopefully not least, I will be briefly discussing what's happened in the Middle East and the Cis Billet Market in the last month since we had our last webinar in June. So one of the big stories was that the United Arab Emirates decided to impose a safeguard duty on pre-painted galvanized coil from the 19th of July. This dates back to April 2018 when the Gulf Cooperation Council initially decided on a 3-year safeguard duty on imports of these 2 HS codes of coated coil. But it turns out that a few GCC countries, including the UAE, chose not to implement that duty, and now have decided to do so from the 19th of July until the 14th of May. So the duty was staggered in terms of the value. Initially, it was started out at $169 per ton in the first year, $153 per ton in the third year. And now, as the UAE is chosen to implement it in the third year, these products will be levied with a $137 per ton duty until the 14th of May. There was a bit of confusion, not much coordination among GCC members in terms of the implementation of this duty. So it does raise the question for future whether or not the GCC will be able to coordinate smoothly on future trade defense action. And linked to this actually, which I haven't put in my slides because it's very fresh and it's just come through hot off the press. Yesterday, the GCC held a hearing on the proposed safeguard measures for a wide range of steel products, flat, long, pipe, that it started an investigation on in October last year. The hearing was attended by around 48 participants, and they argued that hot roll coil and hot dip galvanized coil should in fact be excluded from the investigation because they're not so the tonnages produced within the GCC are not sufficient to cover regional demand. There's only one hot roll coil producer, and in the region, Sabic Hadid in Saudi Arabia, and that producer is estimated to cover around 25 to 30% of regional hot roll coil requirements. So the region is very dependent on imports, and it would make sense that the hot roll coil is excluded from any duties that might be implemented in future. The next step is the participants must provide their points in writing to the trade defense body by the end of this month, and then the investigation will continue. So when a result will come, we don't know yet. Staying with trade measures in Egypt, you may remember last month the country implemented its 10% customs duty hike, which had been talked about for a long time. It was finally actioned. And in recent weeks, last week in fact, I believe, it's transpired that a lot of importers are actually exempt from this 10% customs duty hike, specifically those that use steel as a feedstock to produce their final product. And the exemption has been made obviously to alleviate increased input costs that would have led to local manufacturers being less competitive, and it would have harmed the domestic economy. The exemption applies to companies like fabricators, re-rollers, pipe makers, white goods and engineering product manufacturers, and also to traders with processing equipment who can prove that they are importing under a contract to sell to a manufacturer. The exemption throws into doubt whether or not the steel duty hike last month will have any effect at all, since a large number of importers are exempted. This relates mostly to flat products, of course, because long products have been levied with a safeguard duty since last year, and certain origins are levied with a rebar anti-dumping duty since 2017. So there hasn't been much activity in terms of longs imports into Egypt. Turning quickly now to Turkish pricing. I'm not going to cover this in too much detail because my colleague Burçak Alpan did so very, very well in last week's webinar. But I will mention briefly that since then there were Baltic origin scrap bookings at the end of last week in the range of $260 to $261.5 per ton CFR into Turkey. There was another booking over the weekend at $265, and offers subsequently rose, offers from the Baltic and the US to $270 per ton CFR Turkey. Today we actually had a further booking, at least two, maybe three bookings, which have taken the transaction prices closer to $270 per ton. So the price trend is gradually creeping up, well, it would be interesting to see when or if this comes to an end. Of course, that has increased costs for the rebar mills in Turkey, and that coupled with improved domestic rebar demand, which is very positive because, as you know, the Turkish domestic rebar market has been suffering a lot since the middle of 2018, just before COVID at the beginning of this year, before the pandemic. A rebound was on the cards, consumption was improving, and then the pandemic struck. So for a long time now, Turkish mills have been unable to rely on their domestic market for demand as they did in the past. However, in recent weeks, it's improved, and this combination of factors has pushed up Turkish rebar offers to above $420 per ton FOB. And of course, because the product is more expensive, it's less competitive now on export markets, and the current prices are unlikely to fetch any deals at the moment in the US or in Asia, two big markets which Turkey has sold significant tonnages to in recent months. But another positive development, apart from the domestic demand improvement, is the fact that we understand that Syria has been increasing bookings, notably from Turkey. It's booking around 15,000 tons per month now from the southeastern region, mainly of Turkey, which borders Syria. And many suppliers are hoping that the long-awaited reconstruction of the country is slowly taking shape. Of course, it's early days, but it's one positive among all of the negatives which are happening right now. So if we look at the CIS billet market briefly, Turkish and Algerian buyers have recently booked CIS billets. They returned to the market with higher bids, made bookings. The mainstream offers right now for CIS billet are around $385 to $390 per ton FOB, Black Sea, Azov Sea. This was at the end of last week. Those offers are for September loading material. However, there were several bookings to Turkey of ex-Rostov material at 382 to 388 per ton CFR Turkey, which nets back to around 370 to 375 FOB Black Sea, suggesting that the bookings are taking place at levels below offers. Chinese demand remains in the picture, and the issue is, however, the freight rates were rising, and this was erasing arbitrage and forcing sellers to wait for higher prices in China. But these prices are expected by most suppliers. The so-called golden autumn construction season is promising to be strong, and inventories are seen to be easing. So several traders are claiming that $420 per ton CFR could be achievable this week into China for billet sales. And also the GCC, the Gulf Cooperation Council, there are deals expected to happen to that destination. Buyers there are aware that China is in the market in a big way, buying big tonnages, and of course that doesn't leave many alternatives to the CIS, with Turkish billet offers considerably higher. So I hope you enjoyed those presentations. We are now going to have a question and answer session. If I could ask all of my colleagues to please come back and join me. So we're going to try and have a little bit of a discussion, make it interactive. You still have an opportunity to enter any questions you might have in the control panel on the right. There are plenty there already. So thank you very much for asking. So to kick off, I'd like to start with Emanuele. Go back to the beginning, have a little look at Europe. And do you believe the automotive sector will continue to struggle this year, and that the construction sector is going to drive the recovery in Europe?
Sorry, I had my mic off. Yeah, I think I said it in my presentation in parts. I mean, the reality is we entered the 2020 with an automotive sector that was already struggling quite strongly in Europe. Since mid last year, we had a decline in sales of cars and production of cars across Europe. We all know the reason. There are many factors. One of the factors is the uncertainty for the consumer. So consumers in Europe are not yet sure which car to choose when they want to change it or buy a new one, because there is a big push toward electric cars or hybrid cars. But on the other hand, the offer out there on this sector is not good enough to satisfy most of the demand of European consumers. So it's actually something that we always said during the last year. The slowdown of the auto sector was almost auto-inflicted by the European regulation and the communication that it was sent out to the consumers. So this will continue. So coronavirus only arrived in already a scenario of declining auto sales in Europe, so it's only creating more issues in an already problematic area. On the other hand, construction was picking up a little bit, but the very interesting thing, in my opinion, I mean, I'm now in Italy, but we try to observe the whole of Europe, but we can see across Europe that most of the governments are saying that, well, they reached an agreement on the recovery fund now this week. They will have some room to maneuver to invest in their own economies, and it seems the easiest one to do will be on infrastructures or new constructions or you know, maintenance of existing ones. So there is a feeling that construction will be the easiest one to help and to support in the next months, and already, as we showed, the numbers are already indicating that. So unfortunately, the automotive sector, in my opinion, will continue to struggle quite a lot this year. Yes.
Thank you very much. Emanuela. Turning now to Thomas and China. Thomas, do you, will iron ore remain supported, in your opinion, in this quarter? And will Chinese demand remain strong in the longer term, domestic demand and imports included?
Yeah, sure. So in terms of iron ore, the big picture and the story that kind of dominated over most of the summer was this issue of recovering supply and the fact that that would undermine higher iron ore prices. That hasn't really changed. There's been a bit of a pullback in volumes from Australia, mainly because of the reporting season. So this quarter might see a slightly lower volume from Australia. But over the year, you're still seeing shipments picking up from both Brazil and Australia. Should be quite strong for the second half of the year. So that hasn't changed. What has changed is really the strength of Chinese demand and how it keeps surprising people. Certainly for this quarter, China is now going into a traditional peak season, as you pointed out as well. Construction in the autumn is typically strong. Infrastructure investments typically strong. So that seems to support iron ore as well as steel prices and also steel imports, at least for this quarter. By the end of the year, I think Chinese demand is still likely to be quite strong, and I think there's still a very strong incentive for the Chinese government to keep the local government bond scheme going. There's talk also of new urban renovation projects lasting out from now to 2025. So there's also more of a shift in focus towards medium-term demand growth in China. So for the moment, the outlook for China seems fairly positive. Whether that means imports is maybe another question. I think finished steel imports will always be coming and going, but it's possible that semi-finished imports from Southeast Asia will remain a feature for some time.
Okay, and just sticking with that, we've had a couple of questions from various participants on the background of why Chinese imports have increased substantially, over the recent months. What has been the main driver? Just to give everybody a view of the cause of these imports.
Sure. So the big overall picture is that Chinese demand has been very strong. It's partly been strong because China had actually already began to pump its economy before coronavirus, and since coronavirus, it's added to that. So as soon as economic activity recovered, it's led to higher steel demand. The other part of that is that really China has had quite a lot of success in stimulating infrastructure spending. It hasn't had as much success stimulating consumer spending, but that's a relatively small amount of steel demand in China. Consumer spending is only 8 to 12% of steel demand, whereas construction is really dominant. And then behind that, there's one other key factor, which is the scrap import ban. So China is unable to secure enough scrap to maximize its production potential, basically. It should be importing scrap, but it cannot import scrap. And that has basically led it to import anything else that it can. So it's been importing DRI, it's been importing iron ore, obviously, and semi-finished products and finished steel products, partly because it cannot import scrap, which would be the most logical first choice for it. So that might change next year if they ease that restriction in Q2 next year. That's so far the best guess of when it might happen is Q2 next year.
And as long as Chinese demand for raw materials remains strong and Chinese and for steel as well, and the economy remains stimulated, I guess we don't have to worry in the short term about China returning in any big way to the export market, because this is something that many people were worried about not so long ago, and there were question marks over the Chinese economy, but it looks like the situation has completely flipped on its head now.
Yeah, that's right. I think the China will always be an important exporter, but it's mainly an important exporter for Southeast Asia. Certainly, if you're further afield, you won't see a lot of large volumes of Chinese steel until Chinese steel demand pulls back. And structurally, that's expected to happen in the next few years, and Chinese exports will probably come back. But for now, it doesn't seem very likely to be this year, and it doesn't seem that likely to be a big problem next year either.
Okay, that's good news for everybody else. So turning to North America now, Dan, do you expect a renewed pricing push after the traditional summer slowdown?
Right, and I briefly mentioned this in the presentation, but as of last night, this morning, there has been a new push for hot rolled base pricing. I know, again, as of last night and this morning, US Steel and AK Steel, now Cliffs, have pushed pricing up by $40 a short ton, which would be a big increase in any market, but particularly so after a almost $40 decrease over the past couple weeks. So I interpret this as a line in the sand. That 500 number, we were serious about that. We really want that back. And it sort of remains to be seen whether they'll actually able to be to recoup the loss. On other products, plate, rebar, construction type products, they're sort of at the mercy of the market. The construction market survived the bulk of COVID-19 on backlog. That backlog is now gone. Some starts are up, things like housing, which doesn't consume a whole lot of steel. And infrastructure is the holy grail for most everyone, but that's being tied up by the presidential election, difficulties in Congress, the fact that a huge portion of the federal government doesn't like the president. That makes getting any kind of bipartisan deal done difficult. So I expect a lot of enthusiasm and pushing for higher prices. As to whether or not they materialize, it's honestly an open question at this point.
I see. Thank you very much. And we've had a question from one of our participants here, staying with you, Dan. How do you see the US-China conflict affecting demand? Is it still an issue which is top of the agenda and really having a day-to-day impact on trade, or has it sort of fallen by the wayside now with the COVID pandemic?
It has fallen by the wayside. There was an attempt to revive it, if you'll remember, during the COVID pandemic, with President Trump sort of baiting China as to and blaming China for the COVID situation. But a lot of the bluster of the presidential election has gone. And I would say that's because for the vast majority of Americans, going into 2020, the presidential election was the big news. It is no longer big news. Most people are far more concerned about whether or not they're going to get a stimulus and keep their apartment, their rent freezes. I don't know if the questioner has been watching developments in the US, but there's a lot of domestic unrest. As recently as a couple weeks ago, several major American cities, including my city, Pittsburgh, had giant violent clashes between police and protesters. So I'm sure it bothers President Trump, but he's just not as relevant as he used to be when he gets on Twitter and fights with China. In terms of the actual market dynamics, really the domestic concerns really outweigh pretty much anything going on in the import-export market. The traditional avenue for China to mess with the US market, at least from a pricing perspective, is imports of pipe and tube and fabricated goods. There are tons of trade cases now in place, and nobody wants to send tube to the US right now anyway, due to the pretty I'm looking for a good word here, dormant state of the oil market. The liquidity there is almost nil, which means prices have been stable because nobody's buying much of anything and nobody's sending much to the market. It's just sort of frozen.
Thank you very much, Dan. Coming back closer to home for myself anyway, and a couple of questions on Europe for Emanuele. Do you expect the European Commission to take anti-dumping measures against Turkish hot rolled coil?
Forgot to put my, sorry. Yes, I think we discussed this last month. The reality is, during the last years, it has never happened that an investigation was launched and measures were not imposed in the end. So yes, I definitely think that they will take measures, even though we are in a particular stage, because as we saw in some of the numbers that I showed, imports are going down. They're not that relevant in the market at the moment because, of course, apart from some products, but demand is slow, so mills are trying, European mills are trying to take all the demand available. So we are in a very particular moment, but I think yes, they will take they will put the measures in place. Now the big question at the moment, if I may go further, is not if they will take the measures, but when. So we know that they could come out any moment with the registration system. The registration system, of course, would stop the possibilities in a way to import material straight away, because it would then mean those importing could be hit by retroactive measures. So the reality is, the investigation, the possibility of the registration system, and the provisional measures which could become effective already by the end of the year are already stopping most, let's say, a big part of the trade of hot rolled coil between Turkey and Europe. So if we look closer, the big question is if they will put not really if they will put the measures, but how soon they will impact the market.
Thank you, Emma. And staying with you, given that the demand in steel demand in Europe, as you mentioned, especially for flat products, is relatively subdued at the moment because of the weakness of certain end user industries, what is the likelihood that mills will succeed with their recent attempts to increase hot rolled coil prices?
That's a good question. We tried to address it in the presentation. So the succeeding is difficult to say. Demand is very slow. It's very slow, and the summer period is not helping. We were all expecting, at least, I mean, I'm speaking from a country that was in almost full lockdown for 2 months. We were all expecting that the summer break would be shorter in a way. The summer slowdown would be less intense because of the lockdown that we had before, but this is not happening. Summer seems to be slow as it is always, but of course this year is coming after a very slow period in April and in March and April and beginning of May in particular. Having said that, the reality is prices cannot go down further. Clearly, they have reached their bottom. Profitability on the sales of coils, it's almost close to zero. The mills are still keeping their output under control in a way. So we're hearing ArcelorMittal in Dunkirk ready to restart 1 blast furnace, but let's not forget they have 3 there, and now 2 are down. So they might restart part of it, so 1, but again, they will continue keeping under control their output. The same they're doing in north of Spain with 1 blast furnace down, in Fos-sur-Mer with another blast furnace down. So mills are clearly sending signs that they're controlling output. They need to increase the prices, and imports are not really competitive at the moment. So all signs indicate that prices need to go up. Now the reality is, for them to go up, we need to see transaction at higher level. For the moment, we're not seeing it. So I'm positive that prices will move up, but the only thing I can say is that clearly with iron ore at $110, with scrap anyway supported in a way at the current level, there is no room down. So the only thing we can see is a recovery of 20 to 30 euros, in my opinion.
I see, thank you. And Dan, is the situation in terms of the summer slowdown similar in the US? Are producers keen to continue working basically to make up for the bad previous months that we've had due to the COVID pandemic, or would there be the traditional slowdown as usual?
The biggest emblem of that is the auto industry. Typically, the auto industry slowdown is what leads the U.S. steel slowdown into its curve. The auto companies lost a huge chunk of time and production time, and they have largely canceled summer vacations. They're working increased shifts. It's not likely that we're going to see a full-scale summer slowdown as expected, just due to that running on the treadmill to recoup lost ground. That being said, the economy in general is not doing great, and it's very difficult to tell whether there's a summer slowdown or whether it's COVID related. And reality is it's probably a little bit of both. So industry by industry, I would expect the auto industry to basically skip their summer slowdown. Steel, we saw quite a few projects already moved up, maintenance outages and all that. So they were taken care of during the initial COVID lockdown. They probably will not see the same summer production slowdown. Although with capacity utilization at 58%, how could you really tell? Yeah, so it's sort of a mixed bag. The real test will be sometime early next year. If we see a big spike in pent-up demand, we'll have a better idea of whether we were seeing normal seasonal factors or an abnormal black swan COVID situation.
Thank you very much, Dan. Maybe just one final question, because we're running out of time. One thing which has happened politically in Asia last month was the dispute the border dispute between India and China, and we've obviously had some questions as to whether or not this is going to affect steel trade at all between the two countries. I do know that the chairman of JSW Steel in India, Sajjan Jindal, said in an interview recently that his company will stop buying input material from China as a result of the dispute, the deadly dispute, in fact. But that as long as China keeps on buying from India, there's no reason to stop supplying China. And so far, there has been, in his eyes, no indication that China will stop buying from India as a result of this dispute. Tom, I don't know if you've seen anything, in your end. Have there been any signs that China's less willing to buy from India now because of the political disagreement, shall we say?
So far, nothing that's really stopped trade. There was some talk of some parties on both sides not accepting financing from either state-owned Chinese banks or from Indian banks. But having said that, China has still been buying Indian HRC. I think it's mainly been in the commercial field. It's mainly been rhetoric. Obviously, it was a bloody incident, and it did create shockwaves. But in terms of what traders are thinking, Chinese traders are pretty mercenary. They look for profit the same as good traders do everywhere. They look for arbitrage, and if it's there, they trade. And I don't see that changing at the moment. Yeah.
Thank you, Tom. Unfortunately, we're going to have to end it there. We've had a lot of questions. We couldn't answer a lot of them because there are so many, but we will be sending out an email within the next week to address those questions we couldn't answer today. So don't fret, you will get an answer from us, either from the four of us you see here or our colleagues sitting around the world who can also contribute. I would like to thank my colleagues, Emanuela Norsa, Tom Gutierrez, and Dan Hilliard, for partaking in the webinar today, for giving fantastic presentations, which I hope all of you enjoyed, you found informative. Thank you very much, all of you, for joining us. We really appreciate it. And I'd like to give a big thank you to Borusan Manasman, our sponsor, once again, for supporting this event. We really appreciate your help. A recording of the webinar will be available within the next 24 hours on YouTube. I believe we'll also send out a link if I'm not mistaken. But for now, all that's left to say is take care of yourselves, everybody. Stay safe, stay healthy, and we hope to see you again in 1 month for the next edition. Take care, everybody.
Thank you. Stay safe.